Welcome to my YouTube channel. The word shortage gets thrown around a lot in commodity markets. It usually means a temporary imbalance that prices eventually correct. Supply responds, demand adjusts, and the shortage fades. But what happens when a shortage cannot be corrected by higher prices? What happens when the laws of physics mean there is no substitute? When government mandates lock in growing demand for decades? When mine supply has been declining since 2016 and cannot respond quickly regardless of price? When the single largest consumer on Earth, China, is deliberately hoarding its domestic supply and restricting exports? When a breakthrough battery technology threatens to add up to 1 kilogram of silver per vehicle to an industry already buying millions of EVs per year? That is not a cyclical shortage. That is a permanent shortage. And that is exactly what the silver market is facing right now. Today we are going to build the complete case from first principles for why AI, electric vehicles, and solar energy are not just increasing silver demand temporarily, but are creating a structural supply deficit that the market simply cannot correct within this decade. Let's get into it. Section 1. The deficit that won't close. 6 years and counting. 0.55-330. Let's start with the raw numbers, because they are extraordinary and deserve to be stated plainly. The global silver market has now run a supply deficit for 6 consecutive years. Every single year from 2021 through 2026, the world has consumed more silver than it has mined. The cumulative deficit from 2021 to 2025 alone is approximately 820 million ounces per son for Spercelebakes per son for markets Beckages. That is nearly 1 full year's worth of global mine production, consumed from above-ground inventories, from COMEX vaults, from LBMA vaults, from private hoards, and from industrial stockpiles. To put that number in further context, Bullion Star's analysis, drawing on Silver Institute data, confirmed that global mine production peaked at approximately 900 million ounces in 2016, and has since declined to an estimated 835 million ounces in 2025. A declining mine supply against an 820 million ounce cumulative deficit tells you everything about the structural nature of this problem. And it is getting worse, not better. For 2026, the structural deficit is projected to continue for a 6th consecutive year. While the specific size of the 2026 deficit varies by source, from 30 million ounces in more conservative analyses to over 200 million ounces in more aggressive ones, the direction is unambiguous and consistent across all credible sources. Every major silver research institution, the Silver Institute, Metals Focus, HSBC, the Oregon Group, Science Direct, Bullion Star agrees on the fundamental reality: silver demand is outpacing silver supply, and the gap has structural causes that will not be resolved within this decade. The Science Direct peer-reviewed research model published in August 2025 is the most dramatic projection. By 2030, total silver demand could reach 48,000 to 54,000 metric tons per year, but supply may only cover 62 to 70% of that need. That is a peer-reviewed scientific finding, not a precious metals marketing claim. A 30 to 38% supply gap against projected demand by the end of this decade. And if the wildcard technology we will discuss shortly materializes at scale, that gap could be dramatically larger. Section 2. Solar, EVs and AI. Why the demand is locked in. 330-630. Now let's examine each of the 3 demand forces individually, and why they represent permanent, not temporary, demand. Solar photovoltaics first. The International Energy Agency forecasts solar PV capacity will expand by 3,200 to 4,400 gigawatts by 2030. The European Union has legally committed to 700 gigawatts of solar capacity by 2030. China installed more new solar capacity in 2024 than the rest of the world combined, and its government mandates continue accelerating. These are not market preferences. They are legal commitments, ratified policies, and national industrial strategies. The critical development that most analysis has missed is the shift from perch to TOPCon cell architecture. TOPCon tunnel oxide passivated contact became the world's dominant solar cell architecture in 2024, and it uses 13 to 17 milligrams of silver per watt during initial rollout, versus approximately 10 milligrams for PRC, per especially Silver's January 2026 analysis. TOPCon requires silver paste metallization on both the front and rear sides of the cell, making it structurally more silver-intensive than the legacy architecture that silver demand forecasts were built around. Electric vehicles are the second locked-in demand driver. Battery electric vehicles consume approximately 25 to 50 grams of silver per vehicle, 67 to 79% more than internal combustion engine vehicles. The Silver Institute's Oxford Economics report projects EV demand will overtake IC vehicles as the primary source of automotive silver demand by 2027 and reach 59% of the automotive market by 2031, growing at a compound annual rate of 3.4% through that period. But the real wildcard, the one that no consensus silver demand forecast has yet fully incorporated, is Samsung's solid-state battery. Samsung's AGC, or silver carbon nanocomposite anode technology, uses a layer approximately 5 to 12 micrometers thick of silver carbon composite in the anode of solid-state batteries. This layer prevents the formation of lithium dendrites, the primary failure mode of conventional lithium-ion batteries, enabling higher energy densities and superior safety. Per especially silver's detailed technical analysis, these anodes could require up to 1 kilogram of silver per 100 kilowatt-hour battery pack. Samsung has now moved this technology from pilot lines to the 2026 luxury EV market. If just 5% of the global EV market transitions to solid-state batteries using this technology, the demand shock to the silver market would be enormous, adding 30 to 35 million ounces per year at current EV volumes. At 50% market penetration, the automotive sector alone could consume 300 or more million ounces per year. This is not speculation. It is the mathematics of a technology that is entering commercial production in 2026. AI data centers are the third demand driver. Especially silver identified silver as a quote bottleneck material in AI servers, used in high-speed multi-layer PCBs for low contact resistance, and in silver-sintered thermal interface materials for GPU cooling that achieve 50 to 100 watts per meter Kelvin of thermal conductivity, far surpassing legacy alternatives. The IT power capacity figure tells the story in stark terms, from 0.93 gigawatts in 2000 to nearly 50 gigawatts in 2025, a 53-fold increase, and that trajectory accelerating with each new generation of AI models requiring more computing power. The permanent shortage framework, why each driver cannot be corrected by higher prices. Shortage driver category, why it is permanent, not cyclical. Solar PV demand. Demand side EU, 700 gigawatts by 2030. IEA solar CAGR 17% per year. TOPCon uses 50% more silver than PRC. Government mandates mean demand is legally locked in EV and solid state. Battery demand side Samsung AGC anode, up to 1 kg silver per battery pack. Even 5% SSB market share =, massive structural demand shock. EVs already plus 67-79% silver versus ICE trend accelerating AI data centers demand side silver is bottleneck material in AI servers. Silver sintered TIMs now standard for GPU cooling, 50 minor 100 watts /MK. AI race between superpowers. Government-backed demand. Mine supply peaked 2016. Supply-side global mine output peaked 900 MOS in 2016, fell to 835 MOS in 2025. 71% byproduct. Cannot respond to silver prices. 7 to 10 years mine development lag. Ore grades falling globally. China strategic hoarding. Supply-side China consumes 50% of global silver for its own solar/EV/electronics. Implementing export restrictions on silver and silver compounds. By restricting export, China signals the rest of the world cannot rely on Chinese refined silver to plug deficits. 820 MOS cumulative deficit. Structural 2021 to 2025. Cumulative deficit =, approximately 820 MOS, the Oregon Group. Nearly 1 full year of global mine production already consumed from above-ground inventories. Cannot be replaced quickly. Silver consumed, not recycled. Structural, unlike gold, which is rarely destroyed, silver in solar panels and electronics is dispersed in tiny quantities, making recycling uneconomical. Effective permanent removal from supply. Science Direct 2030 model, peer-reviewed supply meets only 62 to 70% of demand by 2030. Solar alone =, 29 to 41% of AL global silver supply. By 2050, solar uses 85 to 98% of current global silver reserves. Not a forecast. Peer-reviewed Science Section 3. The supply problem. Why mining cannot save us. 6:39 o'clock. Now let's examine the supply side, and why higher prices alone cannot solve this problem. The fundamental constraint facing silver mine supply has 3 components: the byproduct trap, the development timeline, and the ore grade decline. The byproduct trap first. Approximately 71% of all silver mined globally is produced as a byproduct of mining for copper, zinc, lead, and gold. Silver production from these mines is a function of how much copper, zinc, lead, and gold those mines produce, not how much silver costs or how much silver the market needs. When copper mine economics are poor, silver supply suffers regardless of silver's price. When zinc demand weakens and zinc mines slow production, silver output falls. This structural dependency means that silver supply cannot be rapidly scaled up in response to market signals. Even the 29% of silver that comes from dedicated primary silver mines faces the second constraint, the development timeline. From mineral discovery to first production, developing a new mine takes 7 to 10 years on average in the best case, and often 12 to 15 years when permitting. Environmental assessment, community consultation, and infrastructure construction are included. Bullion Star confirms this timeline explicitly. Higher prices alone cannot bring new supply quickly. The third constraint is declining ore grades at existing operations. The richest silver deposits have been mined for centuries, The Oregon Group specifically noted closures across major producers in Mexico, India, Russia, Bolivia, Kazakhstan, and Peru, with ore grades falling at many mature operations. Mining lower-grade ore requires processing more rock to produce the same amount of silver, increasing cost and energy consumption. In an environment where environmental regulations are tightening and energy costs are rising, lower ore grades put additional pressure on mine economics. There is a fourth and critically underappreciated supply constraint: China. China is the world's largest consumer of silver, consuming over 50% of global supply for its own solar, EV, and electronics industries. Simultaneously, China has been implementing restrictions on silver and silver compound exports, restricting the flow of refined Chinese silver to global markets. Trading Key's January 2026 analysis was direct. By restricting exports, China is effectively saying the rest of the world can no longer rely on Chinese refined silver to plug its deficits. This is a geopolitical supply shock overlaid on an already structurally constrained supply picture, and it is a development that most Western silver market analyses are still underweighting. The wildcard: silver content across technology generations, including the Samsung SSB shock technology. Silver content demand implication: if it scales standard per solar cell 10 to 15 G per panel. Established baseline already consuming 240 plus mAh year globally. Topcon solar cell 1317 mg SLAU, 50% more than per C. Already dominant architecture in 2024. Silver per GW rising again despite thrifting narrative. Standard lithium-ion EV battery, 25 to 50 G per vehicle, 67 to 79% more silver than IC. EV CAGR 3.4% to 2031. Silver Institute. EVs overtake IC as primary auto silver source by 2027. Samsung AG solid-state battery, SSB up to 1 kg per 100 kWh battery pack, entering production 2026. If just 5% of global EV market transitions to SSB, adds tilde 3035 mAh for demand instantly. At 50% market share potentially 300 plus mAh for from EVs alone. AI server silver sintered TIM 5100 W1K thermal conductivity. Silver now bottleneck material in AI servers per specially silver. GPU cooling requirement grows with every new AI model generation. Total 2030 demand projection 48,000 54,000 tons for supply covers only 62 to 70% of projected demand. Science Direct peer-reviewed. SSB wildcard, not yet included in consensus forecasts. Actual shortage could be dramatically larger. Sexavin 4. Why this shortage is different. Silver is consumed, not recycled. 9 o'clock 11:15. There is a crucial distinction between silver and gold that explains why the current shortage is fundamentally different from historical precious metals supply crunches, and why the word permanent is not hyperbole. Gold is essentially never destroyed. Every ounce of gold ever mined throughout human history is estimated to still exist in some form as jewelry, coins, bars, central bank reserves, or electronic components awaiting recycling. Gold's above-ground stock is approximately 212,000 tons and growing every year. When gold prices rise, old jewelry gets melted down, coins get sold, and the market rebalances. Silver is different. When silver is used in a solar panel, it is deposited in a layer approximately 2 to 5 micrometers thick across the surface of silicon wafers, dispersed across millions of tiny contact fingers at densities that make recycling economically unviable with current technology. When silver is used in a circuit board, it is alloyed, plated, and soldered into components that will be discarded with the device in 2 to 5 years. When silver is used in industrial catalysts, it is chemically consumed in the process. Bullion Star's analysis identifies this as a critical structural feature. Unlike gold, which is rarely destroyed, silver used in solar panels and electronics is dispersed in tiny quantities, making recycling uneconomical. This effectively constitutes permanent removal from the available supply. The silver installed in the first wave of industrial-scale solar panels, built from 2010 to 2020, will not reach end of life until 2035 to 2040. The silver in those panels will not return to the market in meaningful quantities until then. Recycling currently provides approximately 200 million ounces of silver per year globally. While this will grow as electronic waste processing improves, it cannot close a deficit that is running at 100 to 200 million ounces per year on its own. The contrast with gold underscores the severity of silver's supply situation. Gold's above-ground inventory provides a massive buffer. Central banks and private holders have hundreds of thousands of tons they can potentially release to the market. Silver's above-ground investment inventory has been depleting for 6 consecutive years. The quantity of readily available above-ground silver that can be mobilized quickly is a fraction of what the gold market has, and it has been shrinking every year since 2021. Section 5. The BRICS wildcard and the paper versus physical split. 11:15 13 o'clock. 2 additional developments are amplifying the permanent shortage thesis in ways that traditional silver analysis only beginning to incorporate. The first is the emerging role of silver in the BRICS geopolitical framework. TradingKey's January 2026 analysis provided a detailed and credible account of this dynamic. Russia has begun accumulating silver through emerging market channels, driven by the recognition of silver's strategic value. The Saudi central bank has purchased silver ETFs, a historically unprecedented move by a major central bank, and within BRICS discussions about alternatives to dollar-denominated trade settlement, silver has begun appearing as a potential bilateral settlement metal. TradingKey's analysis describes a specific scenario. Russia exports oil to China and gets paid in silver. India ships manufactured goods to African countries and receives silver in return. That silver can then be used to pay for commodity imports or be added to national reserves. This is not yet a major silver demand driver, but its implications are profound. If silver is formally adopted even in a limited way as a settlement metal within BRICS trade flows, the demand it would generate could dwarf the already significant industrial demand streams we have been discussing. The second development is the growing divergence between paper-silver markets, COMEX futures, ETFs, and unallocated accounts, and the physical silver market. BullionStar's January 2026 analysis describes silver entering 2026 in a state of structural breakdown, with regional physical premiums in Shanghai and elsewhere signaling acute shortages that paper prices were not reflecting. The analysis specifically noted that much of this metal is consumed and effectively removed from circulation, unlike gold, creating a persistent drawdown of available above-ground inventories. When the divergence between paper and physical markets becomes too large, it historically resolves with a rapid and sharp repricing of the paper market upward toward physical. That is the mechanism by which structural deficits eventually force price discovery, not gradually, but in sharp, violent moves, as silver demonstrated when it surged from $33 to $121.67 in 9 months during 2025, closing 13 o'clock, 14 o'clock. Here is the three-part framework for understanding why this shortage is permanent, not cyclical. Part 1. The demand is locked in by law and by engineering. European solar mandates are legal commitments. EV adoption targets are regulatory requirements. AI infrastructure build-out is backed by superpower competition. None of these drivers will voluntarily reduce their silver consumption because silver prices are high. Silver is inelastic industrial demand. The price is a small fraction of the end product's cost, and no substitute offers equivalent performance without a meaningful engineering penalty. Part 2. The supply cannot respond within this decade. Mine supply peaked in 2016. 71% is a byproduct and cannot be redirected by price signals. New primary mine development takes 7 to 15 years. China is restricting exports, ore grades are declining. The 820 million ounce cumulative deficit from 2021 to 2025 has drained the above-ground buffers that historically absorbed supply crunches. Part 3. The wild card could make the shortage dramatically worse. Samsung's solid-state battery uses up to 1 kilogram of silver per battery pack. If this technology scales as Samsung intends, with commercial production already beginning in 2026, the incremental demand shock to the silver market could be larger than all of the solar demand growth of the past 5 years, compressed into 2 to 3 years. The Oregon Group framed the investment case with precision. Solar, data centers, and electrification are not the trigger for higher silver prices. They are the new floor. A true break to triple-digit prices and beyond requires either a major supply shock, such as a production disruption in Mexico, the world's largest silver producer, or a macro-financial event such as a currency crisis. Given the structural shortage we have outlined today, the question is not whether silver will reach those levels. The question is what the trigger will be, and when. Subscribe for weekly silver analysis, hit like if this was useful, and drop in the comments. Do you think the Samsung solid-state battery is the most underappreciated wildcard in the silver market? See you in the next one.